the option Greek. Specifically, what is the primary difference between trading shorter dated options and longer dated options? So the first one to understand is time decay. Options, the value of an option, the extrinsic value of an option erodes to zero as you approach expiration. Now, that erosion does not happen in a linear scale. It accelerates as you get closer and closer to expiration, which is, from an academic and theoretical perspective, why 0 days to expiration favors option sellers, because you get the fastest erosion in that final day of expiration. You actually get the fastest erosion in the final 2.5 hours within the intraday. So if you think about the extrinsic value of an option, it actually erodes almost half of it in the last 2 hours of trading. So if you sold an option, at the open, you would expect about half of the extrinsic value to erode in the first roughly 4.5 hours of trading, and the other half will erode the final 2 hours. So you really get this acceleration on steroids. However, it's important to understand that the acceleration approaches infinity as you get closer and closer to expiration, but because they're already so short dated, the total premium that you're collecting is incredibly small. And it's important to understand to quantify how small that or how little income you are collecting. So what we did is we did some comparison of 0 days to expiration extrinsic values versus 45 days options extrinsic values to get a sense for just how much income are you collecting on a 0 days expiration versus a 45-day expiration, which is our typical expiration cycle when we're looking at cover calls, credit spreads, iron condors, those types of option selling strategies. When we're doing longer dated options, we usually go out about 45 days. So we did some comparisons, and what you find is that 0 days expiration, you collect about 1/8 of the premium that you would typically get on a 45-day option. So obviously, if you were able to collect that premium every single day, in 45 days, there is about 30 plus trading days in that 45 days to expiration. If you were to do that every single day, if you collect 1/8 of the premium, you obviously would come out ahead with regards to the amount of premium that you would collect. But keep in mind that you have to do it 30 something times, which means that you have 30 something times the transaction cost. You have 30 something times the expiration and exercise risks that you have to deal with. Those are 30 plus chances of being assigned on the underlying shares. So it's not, in my opinion, just a great comparison to say, oh, if I just sold 0 days to expiration 30 days in a row versus selling one 45-day option, I'm definitely going to come out ahead. There's a lot more complexity with trading 0 days to expiration every single day. But just to help you quantify how much income you receive, roughly 1/8 of the premium that you would collect if you were to sell a 45-day option. So selling short dated options, you simply get more income per day, but it comes with higher amounts of risk, and it comes with substantially higher transaction costs.